Hey there, it's John Michael with Peridot. I'm here. This is a brief video on a partnership income tax return. That is Form 1065. You can see here it's a U.S. return of partnership income. And I'm doing 2023. You may be into the 2024 tax year right now, but 2023 is very, very similar. Uh, Not much has changed at all from 23 to 24 as far as the mechanics of the form. You may see a little bit of differences, but not enough to make a difference for this video. I'm just doing this prior to that 2024 software being available. So anyways, so we're looking at a 1065 if you're a Peridot client. First thing you might see, well, first of all, just to explain, I'm doing this from my tax software. It's easier for me to jump around and look at the forms. When we provide tax returns to clients, most likely it's going to be in a PDF, so you're going to be scrolling up and down through a PDF. Generally, the first thing you're going to see is this letter. You can see we got it in 2025 here. And this letter is where it just tells you what you need to know. It says, look, do you owe money to the IRS or not? Do you owe money to your state, in this case North Carolina, or not? And the answer is like, yeah, look, you owe $5,700. It tells you how to pay it and all those things. So this first letter, read it. If it's individual, S Corp, C Corp, whatever you're doing, business return, read this letter. It's going to tell you what you're going to have to owe and how to pay it. Um, uh, so that letter is very important. But anyways, Form 1065 is the tax form for a partnership tax return. You do a partnership tax return when there's more than one owner. If it's just one owner, you do not do a partnership tax return. A partnership is more than one person getting together. It's considered a partnership. It needs to do its own tax return, and that's this Form 1065. If you go to your state and form an LLC and don't do anything else, and again, there's more than one owner, the default is to do this return. This is if you don't do anything. The IRS says more than one person needs to do a partnership tax return for the most part. And that's what this is. Now you could, if you wanted, elect to be an S Corp, potentially a C Corp. If you are an Inc., I-N-C, and you form an Inc. as a legal entity, 1065 is not an option to you. An Inc. is an incorporation. If you don't do anything but you form an Inc., then you're going to file a C Corp tax return. You can go and elect to be an S Corp and file an S Corp tax return. So the only people filing a 1065 are people that did an LLC, or if you didn't do a legal entity at all. If you just got together with somebody and decided to do a business together and didn't form an LLC or didn't do any legal entity, it's still going to be considered a partnership. And excuse me, and you're still going to have to do its own tax return, which is going to be reported here on Form 1065. So keep all that in mind. So if you're doing a 1065, it may be because it's the best plan, what you want to do, who knows. But this is a partnership tax return, and this is how to read it and what to look for when you're doing it. So when we look at the very first page of this 1065 tax return, it is a income tax return. So the first thing it does is just, the first page is just what are the income and expenses, but it also provides some information. And keep in mind that a U.S. Return of partnership income is considered a pass-through entity. Pass-through entity means that whoever the owners are of this company, they're the ones that are going to pay taxes on it on their individual tax returns. You do not pay federal income taxes at the entity level when it's considered a pass-through entity. The individuals, the owners, pay that on their personal returns. So you'll see, if you look at this results letter here, there's no money here due to the IRS. Now there may be stuff there that may or may not be income related or whatever. It may or may not happen for the IRS. North Carolina is a different picture. We'll talk about that later. But for the IRS, for federal income taxes, it's a pass-through entity. All this return is an information return, provides relevant information, but the income tax burden, it lies on the owners. That's called a pass-through entity, and then the owners go to their own tax returns, put that income, their share of income onto their own tax returns and pay any taxes if there's any due over there. So again, so this being a information return, a pass-through entity return, it provides relevant information. It says who you are. This is your address. Always review the address. It may or may not be correct. Make sure that's correct. If anything changes, we have to mark that the name changed, the address changed, anything like that. This is the first year, we mark first year. If it's the final year, we mark final year. So check all of that if you're reviewing your own return. You do want to think about that. Well, I moved. Well, we need to get that address. If this is the last year you're doing it, we need to mark that final. So keep those in mind. If this the address changed anything, we need to check, update all that. This is also where you can change the name, tell the IRS what your new name is. This is your tax ID up here. So if you became a legal entity with an LLC or not, you will have to get a tax ID with the IRS. And they give this to you. You apply for that with the IRS. They give you a tax ID number. This here is obviously when did this business start. Over here is, well, what are you? In this example of a tax return here, we're saying this is a brewery. Breweries are fun to look at. And this is a business code number. It's an NAICS. You can look that up. And you want this code to be close enough to what it is you do. So if you look that up, it probably says brewery or something close enough to that. Anyways, it also asks you here, are you cash or accrual method of accounting? Very short descriptive. Cash means basically when you get the money, it's income. When you pay the expense, it's an expense. Accrual is basically saying when it's owed to you, you went out and performed a service, somebody owes you money, well, that's income. And you have a receivable. And you get a bill, you haven't paid it yet, well, that's an expense, and you have a payable. So do you want to account on cash basis? When you get it, it's income. When you pay it, it's an expense. Or an accrual. When it's owed to you or you owe money, it's an income and expense. There's other factors to consider, but that's a very quick descriptive. Generally speaking, most small businesses elect cash for a few reasons. One is just a simpler method of accounting. You don't want to have to think about all the money you owe come tax time or think about all the money that's owed to you, then do cash basis. Another reason you might do cash is you just want to be paying tax on the income you actually got instead of income that's owed to you. But there may be rules that say you have to do accrual or cash. It just depends. You can consult with a tax professional if you want to do that. Typically speaking, though, most people choose cash for no other reason than just the simplicity of the accounting infrastructure. Other information as well. This is a partnership. How many owners are there? A K1 is what the partner gets from it's a form that comes from this tax return that explains your share as the owner of the income on this pass-through entity, on this information return. It will provide a K1 coming from this return. We'll look at those in a minute. But basically that's for every owner, and it's wanting to know, well, how many K1s, how many owners are in this entity? In this example, there's two. There's two owners. Now we just get down to the information. Well, what's the information? It's got gross sales of about 1.5 when you're looking at your return. This is all your money you brought in for the year. And I do want to make sure I cover that a 1065 is a calendar year. So it's going to assume your calendar year, which means January through December, a calendar year, just like a calendar. Or are you doing a fiscal year, which means you're choosing another year end? And if you're choosing another year end, well, what period is this for? You got to let them know. And the tax form number you use always is the beginning. So this is going to be, if your first day of the year is December 1st, 2023, and then most of the years in 2024, well, you're going to do a 2023 form because the first year is that. Now, I don't want to overkill on a fiscal year end because 99.999% of partnerships are going to be a calendar year end. You could do special elections. Typically, that's not going to happen. Typically, you're going to be a calendar year end, and you're not going to see fiscal year end partnership. The only time you really see fiscal year ends is when you look at C corporations. Again, most likely the default and what you're going to be doing is a calendar year end, and it lines up with your personal return. Personal income taxes or on a calendar year as well. Um, okay, so again, first thing it provides is it is an income tax return, so it provides income. It provides the details. I want to know what total money you brought in for the year. I being the IRS, right? Um, what was all the money you brought in for the year? In this example is 1.5 million, pretty good amount. I want to know what were your expenses, and I give you some categories here to put them in. I want to know what your salaries were, what your repairs, what was your cost of goods sold, your rent, so forth and so on. If they existed, I want those expenses. People ask all the time, what categories should I give you? Well, look at a tax return. Categories create themselves. If you have an expense and it has something to do with the business, it is what it is. If you have rent, it's rent. If you have interest, it's interest. If you have repairs, it's repairs. We put them on this line item. There's probably a lot of stuff you're thinking that you don't see here, but that's where statement number 4, line 21 comes in. Let's just jump to statement number 4 here. We jump to these statements, wherever it is, I'm jumping around. It's down here. Here's statement number 4. Here's all those other expenses that you might be looking for, even ones that just we have to, that don't fit in a nice category. If you're not sure, well, we could just write it out here, right? And here's those expenses. So we have 193,000 of all those other expenses. They just kind of come in here in a chunk right here. 193,000. If you want to see the details of that, go to that statement. But you got all your expenses plus all the ones that didn't make it to the front page. So at the end of the day, you brought in almost 1.5 million. You had a bunch of expenses, and the pass-through flow-through is $121,000. That's after everything was written off and everything's expensed and you've done what you've done. Then you're still left with $121,000. That's what we're going to call your ordinary business income. You're going to see that 121 a few places, so let's keep that in mind. When we go to page 2, again, a little bit more information. There's going to be a lot of yes or no questions when you look at these next few pages. If you're reviewing this, looking at it yourself, just go through, and if you see anything saying yes, just see what it says and see if it makes sense. In this case, did any individual own 50% or more of this partnership? Yes, we'll look at that, and we'll look at 1065B1 real quick, and you can see here it says, well, are any of these businesses or any of these individuals? And you can see here we've got individuals. It lists it out here. There's 2 of them here. Don't get over confused, but there's 2. There's Practica and Practice. They both own 50%, and since they're married, that's considered a higher percentage. I don't want to overkill that, but anyways, when you look at these yes or no's, you can see here if you see anything that most of it may be no, but if you're concerned, some may not be applicable. You could just read through them if you're concerned, yes or no. A lot of it is very wonky stuff with partnerships. Partnerships can have very detailed tax consequences and laws. I mean, just like any entity, how big or small you are. I just want to mention that when you talk about tax forms, you have 1065, which are partnerships, 1120S, which are S corporations, and 1120, which is a C corporation, and some other subsets of C corporations or other corporations. Point being, for the most part, you got these 3 forms. So you could be, potentially Amazon, one of the biggest businesses in the world, but they might, depending on their setup, they may be doing all their stuff on a 1065. Sounds crazy, right? Probably not for them. They're definitely not. They're a C corp because they're publicly traded. But my point being, there's some very big companies that would potentially be doing a partnership return or another return, and so there's a lot of questions that may be very detailed and very wonky that just frankly have nothing to do with you. So don't worry about it too much, but if you see anything when it's marked yes, just sort of read it, make sure that applies. One thing that you'll want to look at, and of course they bury it in the middle here, line 16, did you do any 1099s, yes or no? And if you did you file the 1099s that you were supposed to do? So so I'm gonna reverse what I said. Did you do anything that required a 1099? And if so, did you do the 1099? That's the yeses. So if you issued 1099s, if you paid anybody over $600 throughout the year, and were you supposed to do a 1099? Yes. If they're an individual and qualifying. And well, if you're supposed to, well, did you do it? So either yes or yes there. You want to say yes to both, hopefully, or no to both. Not yes then no. Because if you're supposed to do it, you're supposed to do it, and it's a penalty if not, and they're due January 31st. So if you, do those 1099s. Again, just a bunch of yes or no stuff. We can go through those. I'm not going to for the purpose of this video. Just if you're reviewing it, just to see if anything says yes when you review it or not applicable. If it says no, or if it's blank or not applicable, then obviously don't worry about it. It doesn't pertain to you. But you might want to read through them once just to make sure something doesn't potentially pertain to you. So we started at page 1, which is your income, and we breezed through pages 2, 3, and 4 because of a bunch of yes or no questions there. We're jumping straight to page 5. You can see page 5 is Schedule K. I really like Schedule K because this answers a lot of questions for people. People may say, okay, I see my income and stuff. I didn't see the guaranteed payments, but they show up here on the Schedule K. They also would show up here as well. So they show up in those two spots. Back to page 5. Interest income doesn't go on the front page. It shows up here. Charitable contribution doesn't go on that front page. It shows up here. So a Schedule K is sort of the summary of all the income items going on this return. If this is a rental, if you have a rental property on this, a lot of 1065s own rental properties. You're going to see Form 8825 on your rental property form. That is going to be a summary of your rental income and expenses. If this was nothing but a rental property tax return, the front page of the 1065 is going to be blank because rental income is not considered ordinary business income. It is rental income. It's its own thing. So if you're reviewing a rental property return, page 1's blank. That's fine. You find Schedule 8825, which would be after page 6 here in your PDF. And it will have a summary schedule, and it will have your income and expenses of your rental property, and then whatever the bottom line is would show up right here. And that's where that number would come from. It would come from that rental property schedule. But this is what this Schedule K does, is it brings in the totals. This 121, we know it came from that front page. We saw it up there earlier. And it brings in any other totals we need to know and to total here. Why is this important? Well, this is a pass-through entity. I was mentioning that if you're an owner of this, you're going to get what they call a K1. This is all you need as an owner of a partnership to do your personal return. All you really need is this K1, which says this company here, Practice for Fun LLC, paid this person here, Mr. Practice F Fun, not paid. This person here is, in this case, 50% owner of this company, and this is that Mr. Practice F Fund's share, his 50% share of the income items. And if you look at this K1, it is exactly what we're seeing on this Schedule K. The same, it's 50%, but the numbers and the line items here. So the Schedule K mirrors this K1 mirrors the Schedule K, but it is the owner's percentage, your 50%, 30%, 20%, whatever your ownership and profit and loss percentage is. So you got profit and loss and then capital's ownership. This can vary. You may be 50% owners but have 30% of profit and loss. That can and may vary depending on your agreements, your partnership agreements. So you want to look at that. You may be 50% owners, but the profit and loss may vary depending. That's can happen in partnerships, doesn't happen in S-corps, for example, but you do want to look. If you're a partner that didn't get any money, the other partner got all the money for whatever reason, are you getting a K1 taking 50% of that income? You may want to talk about that and if it's valid, if you're supposed to be getting 50% of those profits, because right now that's the way it's looking. Anyways, it's pulling that from that front page. You can see that, well, they're 50% of the income, 50% of the guaranteed payments, 50% of the interest. So the K1, and we can see here Practica, I'm going to say is his wife, um, also is 50%. Makes it easy on us. They both got very similar K1s because they're 50-50. That comes from page 5. Now let's talk about partnerships for a minute. You may be thinking, okay, I'm a partnership. I need money. When you're a partnership, you don't take money in a salary. When you're the owner of a partnership, you don't take money in a salary. If you're guaranteed to get money, like a salary, if the partnership agreement says, look, Mr. Practice Fund here, it's guaranteed to get, $57,000 as a salary for whatever we do, then that's not called a salary. It's called a guaranteed payment. They're guaranteed to get this payment. So it does show up as an expense to the partnership, but it also comes in as a guaranteed payment income. And this is their share of income. That guaranteed payment is an expense in the partnership, but they're still 50-50 owners. So they get the share of the net income, but they also have this guaranteed payment. When we go to their personal return, they're going to have this as income. And in addition to that, they're going to have this guaranteed payment. And the reason for that, again, is it's being deducted here. So when we got to this 121, it was deducted. It reduced this 121. But it's also income to them. So sometimes that happens. In this case, we have 50-50. They're both getting it. Sometimes one partner will get a guaranteed payment and the other won't. So it will show up on one and not the other. But in this case, they're both getting it. But a guaranteed payment, again, it's self-explanatory. If you're guaranteed to get that payment, it's going to be as if it's a salary. It will be a deduction. Partners in a partnership do not get W-2s. They get guaranteed payments. What does that mean? Well, a W-2, you may or may not be realizing, you pay taxes on it as you get paid. The taxes come out of your paycheck. The company sends that off on your behalf. They do the payroll for you. The company covers half your Social Security and Medicare as employer taxes paid. Guaranteed payments, they're not doing that. This comes in. You're going to come over to your personal return. You're going to owe all that tax all at once come April 15th unless you are doing estimated tax payments. And you can see here that this is coming in as well. When you're a partnership, an active partner in a partnership, all of your income is going to be subject to what they call self-employment earnings. And you can see here 118. If you were to add these together, it would be that 118. That's telling us that this 60,000 is subject to self-employment earnings. Self-employment earnings means Social Security and Medicare. So this is going to come in, and this partner is going to have $118,000 show up on their personal return, and they're going to have to pay Social Security and Medicare on all of that $118, and it's going to be due on their personal individual tax return. And unless they paid estimated tax payments, they're going to owe all of that at once, and that may or may not sneak up on you. If you're a partner in a firm and you're getting these guaranteed payments throughout the year and it's awesome, you're just getting these checks and it sounds great, well, keep in mind you are going to owe those taxes on it. So do hold those taxes, do pay those estimates. The company's not doing it for you. It is your responsibility as the partner. Even if you aren't getting guaranteed payments, if you're a general partner in this partnership, this income's going to come in. It will be subject to Social Security and Medicare, all of it, even if you didn't take it out. Even if you just left it in the company and didn't touch it. The company still made your share of $60,000. You still will pay taxes on it. When you're a pass-through entity, an entity that brought in $1.5 million and had all those expenses and made $120,000, somebody's got to pay taxes on that. Just because you didn't get to it doesn't mean somebody's not paying taxes on that. And fortunately or unfortunately for you, you're the owner, and somebody's paying taxes. That is you. And you're paying your share, which is 50% if you took that money or didn't. So keep in mind you're paying taxes on that, and you're definitely paying taxes on your guaranteed payments. So that may or may not sneak up on people. A lot of times people say, why am I getting taxed on $60,000 when I only took out $57,000? Or why am I getting taxed on the additional $60,000 when I only took out this $57,000? Because you're the owner of the partnership. The partnership made $120,000. Your share is $60,000. Somebody's got to pay taxes on that. That somebody is you. That's what happens. No entity gets to make money without somebody paying tax. This entity, this partnership tax return, this partnership doesn't pay its own tax. The owners pay the tax. Okay, so that's what a Schedule K is. This is where the information that the K1s get their information from. So when you're looking and you're like, what am I getting taxed on? Where are my taxes coming from? You can look at the form. The Schedule K comes from other forms. And then your K1 is just going to be your share of the Schedule K. Again, we're an information return, so we still are providing more information. What information are we providing? Well, most partnerships, we have a balance sheet here. If you have certain income thresholds or asset thresholds, this may be blank if you're reviewing your tax return, and this is blank. Don't fret. You don't have to do a partnership. A balance sheet. If you have assets of under $250,000, that's one of these questions I'm bumping around here trying to find here. But one of these questions is it under 250,000? If the answer is yes, you don't necessarily have to do a partnership. In this case, I just misspoke. You don't have to do a balance sheet. So we generally do balance sheets if you have to or don't, because out of redundancy and to explain. So if you see it and if you're under that and you see it, that's fine. It's just being redundant. It's answering questions that don't need to be asked. But if you don't see it, it's fine too. But anyways, this is your balance sheet. So this is why we need to know what are your assets. And when you look at this is last year's ending balance or the beginning of the year, and this year's ending balances. And you can see your cash balances, inventory, assets. We know this from Accounting 101. Assets equals liabilities and equity. So here's your total assets. Here's your liabilities plus your equity is your partnership accounts here. You can see how these are all equal. M1 and M2, very, very, very important schedules. M1 is a schedule that reconciles your income per books with the tax return. So you may be having a bookkeeping software like a QuickBooks. You may pull up your net income in your QuickBooks for the period, cash basis, accrual basis, make sure all that's correct. And you may say, okay, I see 118,000, but I see, this 230,000 coming through, that 230 being the guaranteed payments plus the 120 net income. Why is there a difference? Well, this explains it. Well, 100 of it's guaranteed payments, but the biggest one here, we'll get those out of the way for a minute, is sometimes there's items that are not a full deduction for tax law. The biggest example here is mills. Mills may not be deductible at 50%. So if you do $100 in mills, you're only deducting $50 of it. So your income per books may be lower, but half the mills, in this case, they had about $2,800 in mills. Half of them were not deductible, so this reconciles what that difference is. It's telling us that mills. Keep in mind, entertainment is, most forms of entertainment are 0% deductible, so that's something. I'm not going to talk about deductions and stuff, but that's something that may show up here, or there may be some items here, so you might want to look at that, and this does a really good job explaining the difference between what you may be seeing in your bookkeeping software versus what we're seeing on the tax return. This schedule here, M2, is a great schedule. It basically explains your capital account balances. If we go back up to the balance sheet up here, you can see total capital accounts were 12,000, ending with 81,000. That is your, if we go to the K1s also track right here. It's the same thing, but your share. That's 50% of that 12, and that's 50% of that 81, right? So it's your personal beginning balance, your personal end balance. But if we look at this M2 here, that is the total. So it does the same thing, just 50% of your share. But the total beginning balance, total end balance, again, if we come up here, this is the beginning balance of the capital accounts, the ending balance. They all tie out. We got the 12,000, 81,000. How do we get from this 12,000 to this 81? Well, pretty straightforward. It goes up by your book income here, right? Same number. And it goes down if you do any distributions. You're allowed to do distributions out of a partnership. People may hear draws. They may hear distributions. They may even incorrectly maybe would hear the term dividends, but it would be in reference to this here, a distribution coming out of your company. So you may be saying, okay, yeah, I did guaranteed payments of 114. I also did take another 50 out, the two partners together. So what is this telling us? Well, we start with your beginning balance. If this was your first year, it'd be 0. But you have your beginning balance. This is going to be next year's beginning balance, just to illustrate. It goes up by your income. And if it goes up by your income, we know that 118, we know if we flash over here, you're paying taxes on that. The partners are, their share, right? So we know if it goes up, they're going to be paying taxes on it in their personal return. So they're allowed to take some distributions because they are paying taxes on it. So they can distribute from their profits. And if they distribute, it reduces that number. So it started at 12, went up by their income, went down by their distributions, ended with the 81,000. Very simple. It tells us that you have $81,000 of previously taxed income, cumulative, from prior years. You had 12,000 at the beginning of the year, made another 118, took out 50. So now we're at 81 that you've previously been paying taxes on that you haven't taken out of the company. So you could theoretically distribute another 80. And that would come back out. That would be money that has been previously paid taxes on. If you took out another 80, you wouldn't pay additional taxes on it. Now again, I want to talk about, people may say, why are we as partners paying $118,000 of tax, or paying tax on $118,000 when we only distributed 50, not counting this guaranteed payment because that was an expense before this 118. Why are we, if we only took 50, why are we paying tax on 118? Again, because the partnership made 118. Even though you just took 50, happens all the time. People are confused. I only took 50. Why am I paying tax on 118? Well, the reason being the partnership made 118. You're not hiding that fact. You can't get away from that fact, even if you only took this. And what does that tell us? Well, you're not really, when you take those distributions, that's not a dollar for dollar. You're not getting directly taxed on that. That's an allowance of the fact that the partnership made money, but you're not paying tax directly on that 50. You're paying tax on this 118. The fact that you're paying tax on this 118 allows you to take that 50. That can be confusing. It's a very confusing concept, especially as you're living your life, taking these distributions out, doing your thing, thinking I only took out 50, I'm good, but no. The company still made 118, and that 50, when you took it out, wasn't reducing this unless you called it a guaranteed payment. If you call it a guaranteed payment, you're paying tax on it. So at the end of the day, unless you call it a guaranteed payment, you're paying tax on it no matter what. If you did call it a guaranteed payment, it would just increase your guaranteed payments, reduce this number. It would still both show up over here. Guaranteed payments would be bigger, this would be smaller. It still shows up. You're not getting away from it. There's no smart way around it. If you take money out, it's either previously taxed or going to be taxed, or it's going to be a guaranteed payment. Now let's flip this for a second. Let's pretend like you lost $118,000. You started at 12, you lost 118. We're going to be a net 106 down here, negative, because this is a negative loss. Can you take a distribution? No. What's the purpose of a distribution? It's an allowance of the fact that you're previously paying tax on this income. If you're taking out money that you haven't previously paid tax on, and this is a negative, you can't take a distribution. You could take a guaranteed payment. You cannot take a distribution because you don't have previously taxed income. If you did, you may be thinking, uh-oh, I've taken plenty of distributions. Well, that will either be reclassified as a guaranteed payment, or you'll be taxed on that as overdrawing your basis. So if you're taking money out that you haven't been taxed on, you're paying tax on it. There's no free money, unfortunately, when you're doing this. There's not a free way around it. So keep that in mind. If you're losing money and you're taking money out, you're going to end up getting taxed on that. Okay, so that's a brief, probably not brief enough explanation of a partnership. Plenty more to talk about. I just want to talk about the mechanics so people can understand how to read the tax return, what they need to look for when they review it. This, you may see additional schedules that explain things. If you had cost of goods sold, a brewery does in this example, you may see a schedule giving some details on that. Most of the other schedules just give more details that feed into the main forms. We've looked at the B1, which shows us our owners. The K1s are your share. This is what's going to show up on your personal return. You've got statements down here that give us more details that couldn't fit on those forms. Gives us details of what some of those assets were that were line items that didn't make it. This is a common election that most businesses will probably see. This is when you get assets, you're supposed to depreciate those, write them off over a period of time. This election basically is saying that if you have an asset that's $2,500 or less, you can go ahead and write it off as a supply or equipment or whatever. You don't have to depreciate it. So that's a just sort of a catch-all election. Usually you'll see that just in case you got a $500 something that technically should have been depreciated. This just allows you just to write it off and not worry about the depreciation rules of that item. So if you see all of these, again, the IRS only sees 1065s, the tax forms, and statements. They do not see, if you're looking and you see all these worksheets, or if you see, like some people may look and they see an overflow statement. This is something the software produces that says, look, there's a Mills, we just trunked all these things together and called it Mills. The IRS isn't seeing that. So if you're reviewing this and you're like, what is this? That's just where we got the number from, and that's where it's on the tax return. They may not see it. Point me telling you that if you're reviewing and confused or something. IRS is only seeing the statements and the tax forms. They're not seeing these cover letters or anything like that, or these depreciation schedules. So keep that in mind. But always review this results letter because it's important. And I am going to talk about the North Carolina, and most states have it, what they call a pass-through entity tax. I talked about it in S-Corps. I'll just do it very briefly. Everything I said with the IRS is basically saying that it's passed through, it goes to your personal return, you pay taxes there, we're done. And this is just an information return. North Carolina allows you to make an election to be what they call a tax pass-through entity. And most states, if not all, I think like 48 of the states, I don't know the exact number, but most of the states allow you to make this election to where you could choose to be a taxed pass-through entity, meaning that I want to pay the tax here and I don't want it to pass through to my personal return. Very briefly, there's a benefit to that because it can be considered a business tax as opposed to passing through to your personal return is considered a personal tax. And if it's considered a personal tax, it's not a business deduction. You can't use business funds, right? This way you can use business funds, and if you do, it can be considered a business deduction, and it can offset federal income when you business income when you do this. So it's the same tax rate. You're not missing out on that. So typically it's elected if you see that there's money due. That's why, because it's been elected to do that pass-through entity, which means you're paying the tax here. You're not going to pay it on the personal level. So if you see a tax owed in North Carolina, there's probably a voucher for you. It can pay with the e-file. Just let us know. But if you see that owed, it means that the election was to pay the tax here. It means you are not owed on the personal return. And it means you could use business funds to pay that, and also it could be a business deduction when it's paid. But that's that. So always read that. Typically, you're not going to see any money due to the IRS, but you may see money due to your state. That's a brief summary. Obviously, if you have questions about anything, just let us know. And that's it. Thanks.